Hi, and welcome to From the Research Chair. This is episode 7. For those of you who joined early, in other words, prior to us hitting record, you heard the James Bond music. This is, in fact, episode 007. We're going to be talking about most misunderstood investing concepts, specifically time horizon. I'm Jason Voss, and that is...
And I'm Michael Falk. Hello. And, Jason, I want to make a request for today.
Let's do it.
Because of the number of people that are with us, I know a lot of our guests watch our recordings on YouTube, but might we unmute them and have a little bit more of a conversation for those who have joined us? Because there's only a few.
I don't know how to do a global unmute. I can do a global...
Well, we can make them responsible to unmute themselves. Yeah. I think that's okay.
Let's do that. Let's see here. We'll unmute.
If they wish.
Yes. If I unmuted alum. That was a poor assumption on my part. If you want to be unmuted, unmute yourself. Anyway, hello, everyone. We're talking time horizon. The reason this came up as a subject is because Michael and I, in our consulting work with teams, as well as my experience at CFA Institute, also as a PM, heading research teams, we frequently see confusion about time horizon. I'll give you an example. Michael, you've heard me say almost every debate in finance that I've had over the years and investing over the years is easily resolved when you stop, take a step back and say, hey, what's your assumption for time horizon? And as soon as there's agreement on a time horizon, there tends to be a natural logic that sort of shakes out from that. Michael, have we seen this in our work together where the failure to discuss time horizon is the only confusion?
It is not the only confusion, but we do see it come up a lot. Jason, I'm just thinking of dead weight. Whenever we get into a conversation with our clients about, not the winners or losers you've got in your portfolio, but the stocks or whatever investment have been hanging around for years and going nowhere. That's an opportunity cost. That's time.
Indeed it is. And I would argue that it manifests the time horizon problem in many different ways that are kind of pernicious. And because they're so subtle and because there isn't a lot of conversation about what seems like an obvious concept, the damage can be large. You've mentioned one of them. I would argue that one of the pernicious effects is there's a perennial debate. What's the difference between value and growth investing? One of the favorite... Just time. One of the favorite outs is, there is no difference. Growth investors care about how much they pay. Value investors say, well, of course we want growth in our assets. Time horizon actually is one of the ways in which growth and value investors are different. Specifically, growth investors want higher growth faster, which of course means that they're willing to engage in a little bit more MO, dare I say it, the big MO. Whereas value investors...
Don't fear the mo, Jason. It can work for you. It is a legitimate factor. You don't have to love it, but you should at least like it.
Well, exactly. Or understand it if you reject it. And I think a lot of people don't understand it. And of course, value investors, they tend to have longer time horizons. They want compounding to do their work for them rather than mo. And that failure to understand the time horizon differences, I think, is one of the reasons why we have this odd divide between growth and value. Michael,
well, here's a counterintuitive thought for you. So then I'm listening to that, and I'm thinking, Jason, growth investors actually should have less turnover, and value investors should have more turnover in terms of names coming in and out of their portfolio.
Say more about that.
Well, if value investors care about collapsing and getting fair value. That was a different episode. And so when they do, often they sell, then they have to reinvest. So that's a lot of buying and selling. Growth investors, if they're picking good companies that are continuing to expand their operating cash flows, they don't have to sell. They can just sit tight and enjoy the compounding.
Yeah, it's an interesting point. One of the things that I think about when I think about time horizon in terms of investing is something that I write about in The Intuitive Investor, which we were talking about prior to hitting the record button today. A concept that I actually owned the URL on it and redirected to my site because I heard it quoted a couple of times after I wrote my book, and that is that there's no such thing as a future fact. All facts by definition are things that occur in the past. By definition,
we're not even sure about those anymore, it seems.
Well, be careful, my friend. That was another episode. That was management interviews and lie detection. But in any case, all all of investing's results come from the future, right? So to rely upon past facts to do your analysis is like conducting autopsies when what's really called for is a physical. You need to know how somebody is going to perform in the future, how a company is going to perform in the future. Why is this interesting? One of the ways that value investors, back on topic now, try and solve this problem is through an appreciation for moats. So they spend a lot of time assessing moats. What they're really up to there is to increase the probability that past facts will repeat themselves in the future, because they're essentially admitting I can't anticipate the future. So they then, based on those past facts, do evaluation. And of course, to your point, Michael, they like a margin of safety in case they screw that up. So you could argue this time horizon is baked into this entire process in a very intimate way without it ever really explicitly being like called out. Were you going to say something there? It looked like you were nodding your head, my friend.
I'm just agreeing with you. I mean, it's so clear. Let me give you a real bright line example, if I may. Eons ago, I did private wealth. Now, I want you to imagine a husband and wife, and I'm helping them manage their personal finances and kind of work towards their future. What would you imagine if the husband wanted to retire? Let's say they were the same age. Let's keep this simple. The husband wanted to retire at age 60, and the wife said, I don't want to retire till 65. Do you think that may affect how much they save and how they invest? Oh, yeah. Getting agreement on time horizon, what is your expectation, is critically important. And it just seems that not enough people are having this in the investment industry. Let me come back to investment management. They're not, with their analysts and with the PMs and with the CIO, they're not aligning on 2 years, 3 years, 5 years, whatever the year is, I don't care. They're not aligning on that.
Yeah, and I think that one of the confusions that we see, to put a very explicit number on it or statement about it, we will hear when we work with firms, we're long-term investors. Well, what the heck is long-term? Long-term is a subjective term, and it's so interesting. I've actually done a poll back in the day when I worked at CFA Institute with an audience. I asked them to close their eyes and then by a show of hands to put up their hands. What do you consider long-term? 1 to 3 years? Put your hand up, right? 4 to 7 years, put your hand up. 7 years to 10 years, 10 years greater. And it was all over the place. And it's such a subjective term. And by the way, let's be honest, number of years is entirely arbitrary. That may look like quantification, but I would call it false quantification. What really matters is that time horizon tied to something meaningful, right? And if it's not tied to something meaningful, then it's entirely arbitrary. I've seen research analysts' models when I was a PM that they're 5 years. Every model they submit is 5 years. And I ask, why 5 years? And the answer is, well, it's hard to model after 5 years. Okay, maybe it's not. If your moats are accurate, I ought to be able to model it pretty specifically if the business is unchanging, they're not big acquirers, cost of capital remains low because they generate a lot of free cash flow. Why 5 years? And usually most analysts don't have an answer. I could go on, but you're chuckling.
You're killing me, man. All right. Yes. Here's another example that you got to shake your head at. We are long-term investors. Thinking about an investment manager saying this, we are long-term investors. Our preferred holding period is forever. And when you ask them their turnover number,
it's at zero.
They give you data that shows 25%. And listen, for some people, forever may be 4 years, but my guess is for most people, they are going to be alive for longer than 4 years. Fair point?
Fair point. And 4 is only one part of forever. It's missing the ever part, right?
Yeah, or ever and ever. Yeah, this is such an interesting topic because people, I think, Jason, they don't know how to talk about it. And what I mean by that is, why would you ever, to your point about 5 years, why would you ever set an arbitrary, and yes, I did accuse that of being arbitrary, number to hitch all of your research on?
Yeah, and without consideration for what happens if you model it at 3 years, what happens if you model it at 7 years, what happens at 10. And it's entirely arbitrary. It's subterranean. I've never seen a research team debate that centered around whether or not the time horizon was an important consideration in the valuation model, or it does appear occasionally when they talk about whether or not moats are sustainable. But again, that's usually separated from the valuation model entirely. So what are some of the things you think, Michael, would make it less arbitrary? What could we tie this thing to?
Stop doing it. No. So, all right, I just have to throw out, just for giggles, all right, what if we stopped modeling? Let me explain. What if, from a Porter's Five Forces standpoint, you understood the business? What if, from a proper management interviewing technique from my colleague, you understood how to ferret out real useful information from corporate management? If you understood the business and you could get that accurate information, and this company had a moat or they had something going for them strategically, why do you even have to do a valuation, Jason? If you're going to hold this thing for a long, long time, won't the compounding just overcome any valuation collapse that you could possibly analyze?
Such a great question, and not a rhetorical one. It's actually a philosophical question.
I do that sometimes.
Yeah, indeed. It's
Accidentally.
by the way, I will take this moment to recognize, I love that you're philosophical. I've a brother in arms, Michael Falk. Yeah, like we'll hear conversations in investment teams where they sweat. They may have an arbitrary 15% margin of safety. See our other posts or other podcasts on this subject of 15%, right? And that's, again, arbitrary. It's divorced from anything really meaningful. It's just sort of let's stick our finger in the wind and select a value. And that number, we'll see a debate about, well, the moat or the margin of safety is only 13%. So consequently, we can't possibly invest in the business. And to Michael's point, if your average holding period is very long, the compounding is going to make up for it, much more so than the 2% that you're arguing over on the initial valuation of the security. Michael, what happens when things approach fair value or target price in a firm that is overly sensitive to valuation? What ends up happening typically if it's, say, 10% over target?
The time horizon collapses to zero. They basically are, we're done, we have to sell. That's why I say time horizon. I want to stay in the vernacular of our topic. T goes to zero. It's not 5, it's not 3, it's not 10. And again, it begs the question, why would T ever go to zero? Why does it have to? Business is not liquidating, so the business is not going to zero. And if you're a shareholder, you get the liquidation value. But Jason, what do you think of that? Can T ever, should it ever be zero in the industry?
Well, sure, T should be zero if in fact all the other fundamental factors are violated, right? So T could go to zero.
Like the CEO is a crook and
CEO's
going to jail?
CEO's a crook. You misunderstood the moat and its size. The moat is eroding slowly through competitive pressure. Sure, T could go to zero, but all too often, T should, I think what you're saying and what I agree with, T should not be zero just based on valuation.
Correct.
That's an incorrect reason to have your time horizon shrink to zero, because guess what? The whole reason you have a margin of safety on the front end is because you understand that you may have misestimated the valuation of the firm. Well, that's true on the upside too. But very frequently when firms reach or companies' assets, their securities reach the target price, that's a consideration for a sell. They create turnover, they lose track of the asset, it's gone, or they trim, which creates turnover. And by the way, if it keeps going up, which by the way is the predilection of most great moat companies, then they've left value on the table because they've swapped. Go ahead.
Well, I'm just thinking of the pain of this on behalf of investors. I want to take away the pain. So when you're right and you win, you validate by selling out the winner or trimming the winner. All right. When the stock goes the other direction, is stock, for example, stock goes the other direction, you lose. You think you were wrong, right? Because if you don't sell it and you just take on the pain. All right. So one way or the other, isn't this interesting? So you hurt yourself when you're right and you help yourself when you're wrong.
People do have it backwards, all because
Yes.
of an odd relationship to time horizon, how it hangs out in the background in a somewhat confusing way. If we could summarize, our point is that a lot of value investors or fundamental investors in particular exchange valuation risk. They're so attuned to avoiding valuation risk that they then take on business model risk, even though they don't intend to. So I asked the question earlier, and I'm going to answer the question with some of the things that I think are important. The question was, how do you make time horizon not arbitrary? How do you tie it to something meaningful? And I think it will sort of shake out some of our other points we wanted to make here. One might be a product life cycle for a major product that the firm has. So in the case of Tesla, it might be, what is the natural product life cycle of its automobiles vis-a-vis competition of other electric vehicles? That might be one time horizon you want to model. You could even do individual products that make up the top line. And if you have good analytical resources, you might have individual income statements for products for each firm if they're major product categories. Amazon would be tough because, of course, they're probably billions, or tens of millions, if not billions, of SKUs at Amazon. But nonetheless, you could do by major product cycle. So that's one. The excess growth period of the company, right? And there, you're actually bringing in your assumptions of how long the moat will last. What are the forces that are causing the moat to either grow or erode? Management's ability to manage the moat, to widen the moat, or their inability to keep it at, or sustain it at a certain level. It might be shrinking. One could be market share, right? And market share could be maintained, and you can still erode the moat because you can cut prices to the point where it's ridiculous, and you lose cachet. You also hurt margins if you cut prices. One could be R&D. If it's a technology company, it could be R&D cycles. So if you have transparency into, courtesy of management interviews, some sort of transparency into the product life cycle and what's in the wings and what's about to come live, your valuation model could be based on that. These are all ways of making the time horizon less arbitrary. Michael, do you have some? You take it to the private wealth level.
Well, I'm just so intrigued. Your list, Jason, all tie to strategic aspects of the business. We're not talking about income and balance sheet per se for the math. We're talking about the durability of strategic aspects of the firm, which takes me back to what we were talking about before. What if it's just Porter Five Forces and management credibility, and we're not as focused? And for Amazon, let me just touch on that for a second because you brought up Amazon. How about if we can just split AWS from the rest of the business? Forget about all the SKUs. They don't break it out, right? Because if AWS is not growing and they are the cash that's funding the rest of the business, that would be a good thing to know if it were knowable.
Well, indeed. And this is our natural transition to one of our favorite subjects. Probably could be a From the Research Chair episode. We've brought it up in terms of idea generation earlier, and it's scenario planning. Michael, you and I, you're the only other person I know other than Sloan Ortel, my co-author for the Investment Idea Generation Guide, who has an appreciation for scenario planning. Michael, tell us how scenario planning you believe is superior to strategy, for example.
Well, it's taking strategy to the next level.
Or to forecast
let's just say it that way, because we're talking about the different things that may or may not happen. All right, let's have a little fun here. You start with $100, and let's say you're going to be plus 10% or minus 10%, right? 110 or 90, 81 or 121. You see, I'm going out in time, and then the distribution expands. Well, you pick your number of years, go with 5. Jason brought up that fantasy about 5 years. Look with that ridiculous simple exercise, the number of different outcomes after 5 different steps. All of those different outcomes are different scenarios that could happen. Do you have a sense for the best, the worst, and what are the ones in between in terms of the business outcomes because of their strategies. And what is the predilection of corporate management, the leadership, to actually reinvest proceeds and start a new product line or not, which messes up your scenario analysis, but you can know that exists. All I'm saying is recognize there is not a binary type of forecasting technique. You can actually enter into a scenario analysis structure and understand a much greater level of the potential of the future for that business.
And I'll talk about scenario planning and tie it back to Porter's 5 forces. That's one way of evaluating and parsing the unique aspects of a business that make it a cash flow generating or profit generating, whatever your favorite number is, EBITDA generating entity. One version of scenario planning is invent or imagine different narratives that have a likelihood of possibly happening to the firm. So one would be, have you done in your risk analysis a check on where the manufacturing locations for this firm? What is the political risk that exists in those different geographies in which those plants exist? Is a plant next to a river that has a history of flooding? If you are investing in a firm in Bangladesh, you better have an appreciation for how often a river floods that flows into Dhaka, which is the capital, which if you ever have flown over it, that looks like Louisiana swamp territory because it is. So one scenario would be I lose access to the supply chain. That's one scenario. Another scenario might be I love the CEO. The CEO is getting older. They don't have in place a succession plan. What if the CEO dies? What if the CEO loses interest? What if the CEO gets cancer and checks out for the most part other than occasional check-in? And that ties it to business outcomes. And then again, you can tie this to a time horizon. So in the supply chain interruption, one of the questions you can ask as you're talking to management, or you can try and surface if you don't have access to management, is what is the adaptability or what is the plan in place by the firm to respond to supply chain problems? Ask them, how long do you think it'll take for you to respond to the supply chain interruption? If it's 18 months, well, then your valuation model ought to have that in there. If the CEO dies, how likely do you think it is that they can find a great CEO to come in and and maintain the culture? How long will it take for the new CEO to adapt? Like, this is how you start to make time horizon a valuable, not an afterthought, but an intimate part of how you're looking at businesses.
And Jason, that is just brilliant example you gave. I started everybody off purposefully with the simple math example. Now, instead of using stable numbers, you start getting into these different analyses based upon the strategic potential and or risks of the firm, and you create your scenarios off of those. So it's bespoke, as it should be, fitted to that business. And you get the picture now between the simple math storyline and the specificity of the examples that Jason just gave. That's how you go down the road with scenario analysis.
Indeed. And you can even, it depends on how granular you want to get. When I was a PM, I would go through these different scenarios. I would evaluate them. We revealed a little bit of this in our risk podcast about looking at the unique business factors. And I had in mind a time horizon for which something might perpetuate itself. So for example, a firm has environmental risks that you can identify today. One of the reasons you do a valuation model and you risk adjust it is how do I price this risk factor? But then you can also assign a time horizon, and I did with the various risk factors. How sustainable is this advantage, or how detrimental, what's the length of time that, for example, environmental problems might persist? Is management actively trying to do something about it? What is their prediction for how soon this issue will be a non-issue? I was an owner of Halliburton way back in the day. We were a top 10 shareholder for Halliburton. They had a huge unending liability about asbestos claims because at one point they had manufactured things that included asbestos in them. It was a gigantic open-ended thing, and it was difficult to model that thing. A key component of that was the time horizon over which these claims could continue to exist. Not surprisingly, Halliburton, one of the things that their legal team cared about was only having these outstanding claims open for a certain amount of time, because as soon as they could assign a legitimate, tied to reality time horizon, they could begin to price these things accurately. And that's how time horizon should be important, is it affects value over the long term for these businesses, usually not explicitly dealt with at all. Michael, do you have any other things that you would like to mention on this subject?
Well, what we're talking about where you kind of waded into is pricing externalities. And we can try, but our level of certainty better be really low. But one of the factors that goes into that is societal appetite or lack thereof, right? At what point does society say no tobacco? At what point does society say no more pollution in my rivers and lakes? At what point do they say, I'm sorry, planet's getting a little bit hot? We don't know. But these are all things that if you have a business that has things that are a production of their production cycle, and they're not paying for that secondary production, when and if will they have to pay for that? Should any business not have to pay for all of the results of their work? That's an interesting question. Maybe.
I think it's interesting. So let's start to COVID. Let's walk through an example. How would we, as a well-meaning PM, or in your case, Michael, CIO, think of COVID right now? What would we be doing differently in the COVID era? Well, one would be, how long will COVID last? We'd be trying to get an estimate for what are the different likelihoods and scenarios about a vaccine. How long does it take for the vaccine to onboard? How about the Federal Reserve? They just announced something major yesterday. This will, hopefully, this podcast will be looked at years later. The current context is the Federal Reserve yesterday said they anticipate low interest rate environment through the end of 2020. 23. Oh my goodness, I misread. I just saw
I saw 2023.
Oh, I believe you. I believe you. So that has to be built into your models. Notice when you make the time horizon explicit, things change. We also might be thinking about the presidential election. What does 4 years of Donald Trump look like versus Joe Biden here in the US? How about Brexit over in Europe? And what does that look like? What's the time horizon for the adjustment period? Time horizon is implicit in all of these things, but usually you open up a valuation model, it's 3 to 5 years. I promise you, that's all that you ever see. It's divorced from reality. So that's how I would begin to tie it to a real world example. And of course, it's arbitrary. So that argues play with and toggle your assumptions and see how the value of these businesses changes, along with business factors like margins, for example, their balance sheet, how it looks in different scenarios. It would make time horizon not this silent partner to your valuation model, but an active part of what you're doing.
Yeah, you're making me wonder. You're triggering some thoughts, and that's so risky for our group here. So when you think about the numbers in income statements, balance sheets, and all of the financial statements and disclosures, those numbers are results, are they not? Assuming they're not fraudulent.
They're not.
They're results. Well, you do know that corporate management can't make results. They can make decisions. They can do things that end up costing money or create a rate of return. But the limitation on corporate managements to produce the results, can we just appreciate that for a moment? They don't get to guarantee X level of sales. They don't get to guarantee, well, maybe these days with winner take all, but let's not go there. They don't get to, my point is, if we consider that the numbers that you're analyzing are all residuals of decisions and the market's appreciation or lack thereof of those decisions, we don't, analyzing the market, maybe it's better to analyze the decisions. This is what Jason and I do in the investment world for investment teams. Can you do it in terms of the strategic steps and moats and product lines of businesses? Sure. You can do this.
Easy breezy.
And for the people who are math averse, with none of you, of course, but there are people who don't come in the investment industry because they think it's all math. Maybe it doesn't have to be so much math.
I think what's beautiful about this conversation, about the time horizon one, is The cool thing about the fourth dimension, which time is it ties intimately to the third dimension. And it puts you as an analyst, if you've got the proper mindset, it takes you from abstract thinking into concrete thinking. What's really happening at this business? Over what time? What is the effect of these decisions that businesses are making? The effect can only unfold in that fourth dimension. So fourth dimension is actually not abstract, even though it seems abstract. It's actually a very concrete concept. It's the thing that links all of these other things together, and yet it's usually treated poorly by most analysts. It's an afterthought. I think we've summarized the subject pretty well. Michael, any concluding thoughts before we turn it over to Q&A?
Well, I just like the question when, right? Whenever Jason and I work with investment teams, why, how, when are three primary questions we ask. And you've heard this before, but when is the time question? So why? Why do you think this business is going to make you money? How is the rest of the world going to respect that you're brilliant and you figured this out first? Actually, our investor's going to come in behind you. All right. And when is that expected to happen? So the one element of time that Jason and I are fully supporting is that when you make an investment decision, you actually state for the record for people to understand, I expect this to be good for us, our team, in X period of time. If not, forevermore, right? So when is important? When is important? And that is all about time. Let's kick off some questions. Or Jason and I are going to possibly drop into metaphysical. And let's not have us do that.
As per usual, it's quiet in the question front, which is
crickets.
It's funny because we continue to receive, after last podcast 2 weeks ago, episode 6, again, via LinkedIn, I received a lot of feedback and a couple of emails about questions that people had. But live, people don't want to ask. Any questions about time horizon? Any statements? It doesn't have to be questions. It could be statements about time horizon too. It could be, hey, Michael and Jason, you know what? I think you guys are full of it. I think you've missed it. I always do one business cycle, and that's on average 5 years. That's why I use 5 years. Anything.
Average? Business cycles average 5 years. I don't care if the number 5 is right or not. Oh, please, people, don't use averages. They hide so much useful information.
Indeed they do. Well, seeing no questions,
are we out of time?
Scott, it looks like Scott has taken it off mute. Scott, do you have a question?
Oh, I'll just ask one, right? You know, I deal with a lot of clients, and not being a trust company, we have, you know, literally a few thousand clients. So their time horizons are all different. They have different dynamics, different things are going on. And I've always felt it's part of my job to take the work we do on picking stocks and fit them into these clients' time horizons, which, you know, was probably the most difficult part of the job, because just like Michael was saying earlier, sometimes their time horizons shift because of health or some other types of things, and their T plus 10 or T plus 20 turns into T plus 3 or T plus less than 1 year, you know. And so, you know, a lot of the dynamics of how you are trying to put things into a portfolio and your assessments of that company's long-term prospects get shaded by what you're trying to do for your client, which is completely different if I was managing one pot of money for a mutual fund, or you know, just one high net worth investor that had an infinite time horizon. And again, none of those are infinite either, because they seem to always be shifting their strategies and policies too. So maybe just some thoughts that you might add to that, given the dynamics of everybody managing money for folks in lots of different situations.
I'm happy to, Scott, and welcome to one of the most difficult challenges in the business. You don't have one uniform or alleged uniform client who are using your services. Scott, I'm going to need to take this offline to some extent. I have completed a paper that I wrote that'll be published in November on this very issue, I would argue. And one of Jason and my friends in the industry, who's a CFA who works in the private wealth industry, said, Michael, that may be the closest thing to a unified theory for wealth management I've ever seen. So Scott, let's stay in touch. I'll share the paper with you. It's not an easy task, but I have some thoughts on how you might try and manage it with your clients.
Yeah, Scott, and great question. And thank you for asking your question and also for describing the situation. One of the things that Michael and I counsel frequently on the distribution side at the institutional money management level is spending a lot of time talking to clients to get agreement on time horizon. So within the private wealth domain or the financial advising realm, that would be understanding your client's time horizons, which obviously you do in fact do that. And then evaluating whether or not it's possible for you to execute your strategy over that time horizon. Usually the answer is yes, right? People are dynamic enough and smart enough to be able to, wise enough to be able to adapt time horizons. And things do change, in people's lives. And I do think it's tricky to manage portfolios in that way. I began my career doing financial advising and also had the same experience of differing time horizon. And that's one of the places where the art of the business is little understood, is matching up these differing aspects of client preferences for when things happen. Could be, I got a kid who needs braces. I got a kid about to go to college. My wife and I would like a second vacation home. We've been going to this location for years and years, and we love it. And we'd like a vacation home in that same place. How do we afford it? Then we've got retirement, or we need a new car, or whatever. I think the private wealth domain, it's much trickier than it is at the institutional level. And obviously, our comments today were there, which I'm somewhat embarrassed to say that Michael and I didn't really think about it. One thing I'll point out.
Well, I can make an addition, but Jason, finish your thought.
Yeah. One final thought here. We have not talked about, but I predict we will in the future, about different behavioral biases. Here specifically, I'm thinking of mental accounting. Mental accounting biases, I think, one of the more interesting of the biases, because I think it's one of the ones that disappears as soon as you bring in time horizon, because mental accounting says you shouldn't have different decision rules for different buckets of money. It's all just money. But that's a statement made in ignorance. And the reason it's made in ignorance is because it's ignored time horizon. It's treated every allocation of money on some sort of unknown, unstated time horizon. But as we all know, that if somebody has a funding need in the next 3 years, we invest differently than if it's 50 years into the future, which is due. So anyway, with that comment, Michael, you're so much more versed in this space than am I. Go ahead.
Well, I just want to add, Scott, with appreciation your question, I will sometimes use time as a mediator of what's going on in the markets. Let me give you an example. So let's say you've got a couple who wants to retire in 12 years. A silly example. The market has gone down quite a bit. They are really nervous. They call you, they come to see you, and they say, Scott, what should we be doing? What are you doing? And you can say, well, let me ask you a question. You wanted to retire in 12 years. Right now, you can retire in 13 years or 12 years, 6 months. Is there anything you'd like to do? So we rephrase this as an actuarial. We rephrase the issue in the vernacular of time, because time they can respond to. They can say, no, I don't want to wait 1 extra year or 6 months to retire. And now that gives them trade-offs. You have trade-offs of what you can do. You can contribute more into savings right now. You can actually take more risk with your investment right now, or you can do nothing. Those are the 3 fundamental choices that that person has with your counsel at that point in time. This is the core of that paper I wrote. So Scott, I hope that at least helps a little bit, or gives you, say, a thought that maybe this could be useful. I'd like to read that when it's out.
We'll assume so. I hope so. Interestingly, Michael, when you're speaking, this is one of the reasons why it's so fun to do these podcasts with a partner, is we can spark one another. One of the things that I used to do as a PM with regard to time horizon was to track the turnover that was taking place in the S&P 500, which you can do if you have a database that includes the number of shares for each company that are outstanding. You have that total and you look at the trading volumes, you can get a sense of what the time horizon each day was for, quote unquote, the market. And that can be a fascinating thing to see how that changes. Day to day, not so interesting unless it's a huge blow up day where a lot changes either up or down. But it is interesting on a weekly, monthly, quarterly, annual basis to track that, because it tells you it's kind of an indirect measure of risk that's embedded in the market as well. So that's one thing I used to do that I had forgotten until, it's been a long time since I managed money. I'm getting old, my friends. But anyway, that is something that I used to do that is a fun thing to play with. Are there any other questions? I think we take that as
Come on, I don't think we were that harsh on Scott's question. Come on, people. Fear not. Or, Jason, maybe they've all run out of time and they have to go.
Touche. Their time horizon is however many minutes we've been doing it. So our next podcast from the Research Chair, episode 8, again, subject has been not decided as of yet. Michael and I will discuss it. It will be Thursday, the 1st of October at noon Eastern Time, 11 Central. Want to recognize your time horizon or your time zone, Michael. And we'll see you next time. Thank you so much for joining us.
Thanks.
See you in October, all.
Bye, all.